Hello student, this is Vaibhavi, your teacher. Today we are going to learn how to solve a case study of insurance and risk management. Case on risk management. The past decades has seen a dramatic rise in the number of insolvent insurance. The ostensible causes of these insolvencies were myriad. Some of the insolvencies were precipitated by rapidly rising or declining interest rate. Others resulted from losses on assets, mispricing of insurance policy, natural catastrophes, and changes in legal interpretations of liability and the limits of coverage hurt still others. The churning of policy by unscrupulous sales agents, insolvencies among the reinsurance backing the issued, policies issued, non-compliances with insurance regulation and malpractices on the part of officers and directors of the insurance companies affected some as well. The causes of insolvency in inadequate risk management practices. With one causes, we are studying how to manage the risk involved in the insurance industry franchises. Risk as a central ingredient in the industry's franchises. A franchise is a right granted to an individual or group to market a company's good or service within a certain territory or location. Insurance are in the risk businesses. In the process of providing insurance and other financial services, they assume various kinds of actuarial and financial risk. Market participants seek the services of insurance because of their ability to provide actuarial risk, pulling through their major product line of life and other financial instruments. At the same time, they are major providers of funds to the capital market, particularly to the fixed income sector. In performing this role, they generally act as a principal in the transaction. As such, they use their own balance sheet to facilitate the transactions and to absorb the risk associated with them. The risk contained in the insurance product sales, that is, those embedded in the products offered to customers to protect against actual risk, are not all borne directly by the insurer itself. In many instances, the institution will eliminate or mitigate the actuarial and financial risk associated with a transaction by proper business practices. In others, it will shift the risk to other parties through a combination of reinsurance, pricing and product design. Only those risks that are not eliminated or transferred to others are left to be managed by the firm for its own account. This is the case because the insurance industry recognizes that it should not engage in businesses in a manner that unnecessarily impose risk upon it, nor should it absorb risk that can be efficiently transferred to other participants. Rather, it should only manage risk at the firm level that are more efficiently managed there than by the market itself or their owner in their own portfolios. In short, it should accept only those risks that are uniquely a part of the insurance array of services. Elsewhere, it has been argued that risk facing all financial institutions can be segmented into their three separable types from a management perspective. Five these are: a risk that can be eliminated or avoided by standard business practices. B. Risk that can be transferred to other participants. And C. Risk that must be actively managed at the firm level. In light of the above, what are the necessary procedures that must be in place to carry out adequate risk management for those risks that are essential ingredients to the insurance franchise? What techniques are employed to both limit and manage the different type of risk, and how are they implemented in each area of risk management? It is to this question that we now turn. In general, the management of an insurance firm relies on a variety of techniques in their risk management system. However, it appears that common practice has evolved such that four elements have become key steps to implementing a board-based risk management system. These include: A. Standard and reports. B. Underwriting authority and limits. C. Incentive investments, guidelines or strategies. And D. Incentive contract and compensation. These tools are established to measure risk exposure, define procedure to manage these exposure, limit exposures to acceptable levels, and encourage decision makers to manage risk in a manner that is consistent with the firm's goals and objectives. In performing this role, they generally act as a principal in the transaction. As such, they use their own balance sheet to facilitate the transactions and to absorb the risk associated with them. Therefore, it is here that the discussion of risk management and the necessary procedures for risk control has centered. Case analysis. The above case has divided into three parts as the role of insurer plays in financial sector, the risks which are to be managed, and how are these risks managed. A. The role of insurance in the financial sector. Actuarial and financial risk is in providing insurance and other financial services for the insurance. They are major providers of funds to the capital market, particularly to the fixed income sector. B. What risks are being managed? The practice of risk avoidance involves actions to reduce the chances of individual losses from standard insurance activity by eliminating risks that are superfluous to the institution's businesses purpose. Common risk avoidance practices including at least three types of action. 1. The standardization of processes, insurance policies, contracts, and procedures to prevent inefficient or incorrect financial decisions. The construction of portfolios on both sides of the balance sheet that benefit from diversification and the application of the law of large number and central limit theorem, which reduce the effects of any one loss experience. 3. The implementation of incentive compatible contracts with the institution's management to require that employees be held accountable. In each case, the goal is to right the firm of risks that are not essential to the financial services provided or to absorb only an optimal quantity of a particular kind of risk. There are also some risks that can be eliminated or at least substantially reduced through the technique of risk transfer. Market exists for many of the risk borne by the insurance firm. 1. Actuarial risk can be transferred to reinsurance. Catastrophe risk can be offset somewhat by undertaking a position in catastrophe future and perhaps even in catastrophe bonds. 3. Interest rate risk can be hedged or transferred through interest rate products such as swap, caps, floors, futures, or other derivatives products. Insurance policies and lending documents can be altered to effect a change in their duration and convexity. 4. Equity market risk can be reduced with an appropriate future position in equities. In addition, they can offer the products which absorb some financial risk while transferring some of these risk to the purchaser. Defined contribution pension plans and variable universal life policy are clear examples of this approach. Finally, the insurers can buy or sell financial claims and reinsurance to diversify or contract the risk that result from servicing its clients base to the extent that the actuarial and financial risk of the insurance policies underwriting by the firm are understood by the market. They can be sold in part or in whole at their fair value unless the institution has a comparative advantage in managing the attendant risk and oblique or a desire for the embedded risk they contain. There is no reason for the insurer to absorb such risk rather than transfer them. However, there are two classes of activities where the risk inherent in the activity must and should be absorbed at the insurance firm level. In this case, risk management must be aggressive and good reasons exist for using firm resources to manage insurance level risk. The first of these includes actuarial exposure, where the nature of the embedded risk may be complex and difficult to communicate and transfer to third parties. For example, Progressive Insurance Company has a defined niche in the high risk auto insurance businesses owing to its concentration of underwriting activities, and Lutheran Brotherhood has a natural advantage for writing life insurance to its clientele. A similar situation may arise on the asset side of the business where the insurance holds private placement and other complex properties assets that have a thin or even non-existent secondary market. Communication in such case may be more difficult or expensive than heading the underlying risk. Moreover, revealing information about the customer may give competitors an undue advantages. They are listed together because they are the sine qua non of any risk management system. Underwriting standards, risk classification, and standards of review are all traditional tools of risk control. Consistent evaluation and rating of exposures of various types are essential for management to understand the risk on both sides of the balance sheet and the extent to which these risks must be mitigated or absorbed. The standardization of financial reporting is the next ingredient. Obviously, outside audits, regulatory reports, and rating agency evaluation are essential for investors to gauge assets quality and firm level risk, but the types of information collected and the manner in which it is assembled and presented in statutory accounting reports are inadequate for the purpose of managing an insurance company. For instance, it is difficult to discern discern the magnitude and import of options insurance have effectively writing on both sides of the balance sheet, that is called an prepayment options and loan commitments on the asset side, lapse, loan and surrender options on the liability side. By relying merely on statutory accounting report, the second case includes risk positions that are central to the insurer's business's purpose and are absorbed actuarial risk inherent in the key insurance lines where the insurer may enjoy a competitive advantage or a market niche is a clear case in point. In all such circumstances, risk is absorbed and needs to be monitored and managed efficiently by the institution. Only then will the firm systematically achieve its financial performance goal. See, how are these risks managed? The following are the techniques to apply to control each of the specific risks facing the insurance community. Standard and reports. The first of these control techniques involve two different conceptual activities, that is standard setting and financial reporting. It is also difficult to estimate interest rate risk and default risk from the information provided there. The statutory accounting reports have long been standardized for better or worse. However, the need here goes beyond public reports and audited statement to the need for management information or actual risk, asset quality, and overall risk posture. Such internal reports need similar standardization but much more frequent reporting intervals with delay, weekly and monthly reports substituting for the quarterly statutory accounting periodicity. Thus, the collection and presentation of sufficient data to adequately manage the risk exposure of a company is a starting point. Underwriting authority and limits. A second technique for internal control of activity management is the use of position limits and or minimum standards for participation. In terms of the latter, the domain of risk taking is restricted to only those customers or assets that pass some pre-specified quality standards. Then, even for those that are eligible, limit are imposed to cover exposure to counter parties, created an overall position concentration relative to various types of risk. In general, each person who can commit capital, whether on the asset or liability side of the ledger, will have a well defined limit. This applies to underwriters, portfolio managers, lenders, and traders. Summary reports show limits as well as current exposure by businesses unit or on a periodic basis. In large organizations with thousands of positions maintained accurate and timely reporting in difficult but even more essential investment guidelines or strategies. Investment guidelines and recommended position for the immediate future are the third technique that is commonly in use. Here, strategies are outlined in terms of concentration and commitment to particular area of the market, the extent of desired asset oblique liability mismatching or exposure to interest rate risk, and the need to hedge against systematic risk of a particular type. These limits leads to passive risk avoidance and or diversification because managers generally operate within position limit and prescribed rules. Behind these guidelines offer firm level advice as to the appropriate level of active management given the state of the market and the willingnesses of senior management to absorb the risk implied by the aggregate portfolio. Such guidelines extend to firm level heading and asset liability matching. In addition, scrutinization and even derivative activity are rapidly growing techniques of position management open to participants looking to reduce their exposure to be in line with management's guidelines. Similar guidelines are required on the liability side of the balance sheet. Underwriting standards and strategies are needed to ensure that the risk accepted conform to the parameters that the insurer is capable and willing to accept. They also foster better pricing of products and prevent any one underwriter from compromising the future solvency of the firm. Incentive schemes. To the extent that the firm can enter incentive comparable contract with senior management, lines managers, and sales agent and make compensation related to the risk borne by these individuals. Then the need for elaborate and costly control is lessened. However, such incentive contracts must be consistent with the insurance financial goals and require proper internal control system. Such tools, which include underwriter risk and loss analysis, incentive investments risk analysis, the allocation of costs, and the setting of required return to various parts of the organization, is not rival. Notwithstanding the difficulty, well-designed system align the goal of managers with other stakeholders in a most desirable way. In fact, most financial debacles can be traced to the absence of incentive compatibility. For instance, the leakage of compensation to sales can lead to reckless and dangerous growth and poor underwriter or mispricing of risk. The linkages of managerial compensation to book earnings can lead to the acquisition of investment with negative convexity during mismatch risk, liquidity risk, and credit risk whose book yields are higher than their expected return. The students today will learn in detail how to solve the risk insurance and risk management study. Thank you.